welcome everybody. This is our live AMA. And with me today are Ben Murray, founder of the SaaS Academy, and him as the SaaS CFO. And of course, our own Head of Origination at SaaS Group, Dirk Sahlmer. And we're talking about mastering SaaS finance and metrics. So let's get started. Very exciting topic. Nerdy, but exciting. So let's maybe start with a bit of a longer introductions from you guys. Ben, will you do the honors?
Sure. Yeah. Thanks, Anna. Great to be here. Great to see everyone. My name is Ben Murray, known as the SaaS CFO. I came up through the ranks of FP&A in the airline industry, got into software in the early 2000s, became SaaS CFO at founder and private equity-backed businesses, and now for the past 3 to 4 years, living and breathing SaaS. So fractional services, coaching, have an academy, teach SaaS metrics and finance, and then my blog that I started in 2016 where I share templates, forecast models, SaaS metrics calculations, just in-depth post about SaaS metrics. So great to be here.
Awesome. Welcome again. It's great to have you here. Dirk?
Yeah, so I still went to school in the early 2000s and didn't know anything about SaaS. I'm Dirk. I'm based in Germany, near Cologne, and I started my career in the mechanical engineering automotive space before I pivoted to SaaS, which was quite a career change. And I basically used, amongst others, Ben's material to train myself and educate myself on SaaS stuff and finance stuff. And so, great to do this session with Ben together today.
Are you nervous? Meeting your teacher live. So the first question is how to start calculating each of your metrics and what metrics are actually relevant for B2B SaaS companies, especially in kind of our SaaS group range up to 10 million ARR. Ben, want to start?
Yeah, no, that's a great question. It's a big question, and it's easy to get overwhelmed with all the SaaS metrics out there. So if you're less than 10 million, I always say the right metrics at the right stage. A lot different if you're 1 million ARR versus 10 million. And that's why I have created my 5-pillar SaaS metrics framework. And there are 5 pillars, and it moves left to right. And I'm happy to, Anna, share that link so people can access that and download it. But first is growth, right? Getting new customers, expansion revenue. How many customers are we getting? And then it moves to retention. So we gain the customers. Now, are they staying with us? Looking at customer retention, gross revenue retention, net revenue retention. And I move left to right in kind of our SaaS metrics maturity as we scale to 10 million. And then it's about our margin profile. What kind of gross profit are we generating? Is it close to best in class 80%? What kind of margins are we producing by revenue stream? Because no longer are we just subscription revenue. We've got professional services, managed services, variable revenue, hardware revenue. And then we go to our financial profile, Rule of 40, EBITDA, our OpEx profile, and finally, the fun part, sales and marketing efficiency metrics. So CAC payback, LTV to CAC, cost of ARR. And then also, we can't forget org efficiency. If we're looking for that path to profitability, we have to understand org efficiency because the biggest expense investment on the SaaS P&L is people. Our staff and our contractors. So looking at revenue per FTE, and then I created a metric called the ROSE metric that looks at the recurring revenue generated for every dollar of employee and contractor investment. So covered a lot there, but big question. A lot to cover there, but there's a progression with our metrics.
Okay, Dirk, anything to add?
No, I mean, this was already a great answer, so not a lot to add, but I think maybe in a broader sense, I think in the first step, it makes sense to maybe stay a bit more high level. And as you said, like generate growth, which means revenue growth, new user signups and all that stuff. Also maybe a bit more top of funnel focused, even though you mentioned retention as one of the topics. And then become more granular over time, then profitability of certain channels, gross margins of different revenue streams and stuff like that. So this can also happen maybe at a later point if you have more or finance resources at all, maybe kind of a RevOps function or something. But if you just get started, I think it's first about growing and getting traction in general.
Keeping it simple. So what are the indicators that show that the business is actually working? Ben?
Yeah, so there, Dirk mentioned like, of course we have pipeline. CFO is very interested in pipeline and lead funnels, and that's a big piece of it. But if we think on the finance side, one, that I find with working with a lot of SaaS companies is gross profit. As we're scaling, I find that a big cash hurdle, if we have low gross profit and we're struggling with cash and positive EBITDA, usually we have a gross profit problem. Say, if you're running 50%, 60% gross profit margins overall, and you're trying to scale the profitability, it's just a high hurdle. It's hard to get there, because if we're producing revenue, but it's costing a lot to deliver that revenue, the cost of revenue or cost of goods sold, so that is a key indicator. And again, it's a fundamental metric, and they're called fundamentals for a reason, right? They just don't go away. So we have to understand our gross profit profile. And then I find, I interview a lot of founders for my podcast, and there is a sequence as a company scales, right? We develop the product, then we're trying to look for product market fit. Then maybe we see some signals from the market, and then we start scaling up. But if we start overlapping some of these sequences that should be sequenced instead of on top of each other, that can cause a lot of trouble. And I call that the SaaS Valley of Death, when we're trying to find product market fit, but then we're trying to scale our go-to-market function. And then of course cash, right? We've got to look at cash generation. So a lot to cover there, but just a few things that pop out.
All right, Dirk. Well, when you're trying to buy a company, what tells you it's working?
Yes, I would say that you are able to acquire customers efficiently and profitably, which is also something we especially see with highly VC funded companies, that they of course have cash to spend and they may be able to acquire customers, but how long are they going to stay? Are they able to get the acquisitions cost back within a reasonable period, stuff like that? So just to see that whole like cycle from acquiring customers, earning back acquisition costs, and generating more revenue from a customer that you initially spend on acquiring them. I think that's an important point. And the metrics are maybe a bit different when we refer to a PLG company versus sales-led in terms of like sales cycle and stuff. But in general, like, I don't know, metrics like LTV to CAC payback and stuff like that. Also magic number that come to mind that you should track to see if you are able to, build that flywheel that can acquire customers profitably.
All right, perfect. So when we talk about metrics, we often talk about benchmarks, and I mean, we often post about different benchmarks and the different reports from a number of companies. So should founders really kind of fall back on benchmarks when they're working with metrics, and how to determine which benchmarks would actually make sense to look at? Ben?
Yeah, I think we have to be careful there, because I talk to a lot of founders in kind of the early stage, maybe a million or two of ARR. And generally, there's just not enough volume of data flowing through the business yet to really calculate good metrics that mean something, that are valid for our business. So then benchmarks don't matter. So again, right metrics at the right stage. But once I find 3 to 5 million ARR, especially 5 to 10, then there's enough volume of data, meaning customer acquisition. We're acquiring, a decent amount of customers per month. We're investing in certain areas of our business, that then there's enough data for CFOs to really latch on to and calculate the SaaS metrics. So then once we have the metrics, then benchmarking. It's important to know, how are we performing against the market, and that also affects valuations and those valuation conversations. And the big thing is, aggregate benchmarks can be dangerous to your SaaS health. There are a lot of great reports out there, that look at just total population of SaaS metrics, but really we have to benchmark our business based on our financial profile. Because if I'm looking at a $50 price point business, $50 a month versus $50,000 a month, that's going to change my perspective on how I view those metrics and what benchmarks I'm going to use. So we have to be very careful, but benchmarks really important to understand, and it often can help us set goals of where we're trying to move with our business.
Thank you. That makes sense. Dirk?
Yeah, I would also just add that you should always take these benchmarks with a grain of salt because it's always like a simplification, generalization of things, and they may not necessarily apply to your specific business and your specific segment. And most of the SaaS benchmarks you find out there are very generalistic. So they are not, I don't know, focused on cybersecurity SaaS versus maybe productivity tools. Also in terms of your GTM motion, whether you're product-led or sales-led. So I think I'm a fan of benchmarks, and I'm sharing a lot of stuff there on LinkedIn, but you should always take these benchmarks with a grain of salt and see to which extent they should make you nervous or should change how you approach your business operations. But as Ben said, as you gain more data, as you grow bigger, it's a good orientation. At least if you look at benchmarks in terms of churn and stuff like that, so you can see, okay, in which upper range are you? Should you work on churn reduction and stuff like that, so it can influence your decision making.
Do you see some companies kind of like abuse the benchmarks when they come to acquisition discussions? Dirk?
Good question. Well, not misusing, but I think it often leads to discussions, especially if I had a post on a certain topic and they say, hey, look, we have best in class retention and stuff like that, but then there's something else that doesn't look that good, and they try to justify, for example, higher price expectations with an individual metric being top notch, whereas many others are not looking that good. So that's what I'm saying, like the full picture is relevant and not whether you are very good at specific KPIs. So it can lead to discussions there, and it sometimes happens. But yeah, it's not like every day.
Okay. So what are actually the metrics that acquirers want to see kind of right away, maybe even on the first call when they're approaching a company for a potential buy? Dirk, let's just continue with you this one.
Yeah, I can, of course, only refer to SaaS Group here. And for us, also many soft factors are relevant. And it also depends on the buyer profile, right? So if you have a growth buyer, they are, of course, interested more in growth than maybe profitability. For us, since we have that long-term evergreen approach, for us, profitability is a bit more important. And so it really depends, but you can find lots of lists of the top companies that influence valuation and that acquirers want to see. I mean, we already talked about it, growth, but efficient growth, so a good balance between growth and profitability is, I think, important. So if you grow, I don't know, exponentially 60, 70, maybe over 100%, you should make sure you're not burning cash like crazy, so it's at a reasonable level. And on the other hand, if you're not growing that much, you should make sure that your bottom line fits to that growth profile. And then it's also, generally the quality of revenue. So at which pace can you acquire new revenue? Can you retain it? Can you expand cohorts? So how are you growing? How are you retaining customers? What is your ARPU profile? Were you able to increase ARPU over time? So many things that come into play here that show whether that's a decent business, which also has kind of a mission critical character, or it's just a nice to have tool that's surfing on a trend wave, but it's not really sustainable.
All right. Ben, have you had an experience maybe working with companies who are looking into an exit? What are they preparing?
Yeah, definitely. So to add on to that, like looking for an exit or fundraise, the biggest thing or one thing that's really important is your MRR schedule. So your revenue by month, by customer, or by product line. And this is where I've helped a lot of SaaS companies where it seems simple, but it can be very hard to produce. Or you've had poor invoicing practices that then makes that data really faulty. Or maybe, if we invoice annually, we have to put a RevRec schedule in place, to create that schedule. So important, because why do all acquirers look for that? Because then they push that into their retention template and they can calculate customer retention, gross revenue retention, net revenue retention, to see the health of your recurring revenue, and also by revenue category, subscriptions, maybe you have some variable revenue in the form of usage, transaction, etc. So your MRR schedule is so important that you can produce that accurately. Otherwise, it's just going to be a very tough discussion if you can't answer revenue retention questions. And I've talked to some firms where if you can't even produce a retention number, they're passing, or their minimum threshold is 90% GRR. And if you can't show that, you just have to come back another time.
All right. Okay. Well, since we have already touched upon the benchmark, there is an interesting comment slash question. Do we really need benchmarks? I would rather set profitability and growth goals and work backwards to set the metrics for my business. What do you think about that, Ben?
So do we need benchmarks? I mean, I think if you have revenue targets, profitability targets, that's a piece of the puzzle. But one thing with metrics and benchmarks, of course, we're calculating historically, but I'm also calculating on a forecast basis over the next 12 months. And that's where the power of this data is as we're investing in our company, in people and contractors, in our go-to-market motion, whatever it is, how does that impact our business financially? What does that do to CAC payback, cost of ARR, et cetera? What does it do to our margins? So it's not just historical, it's also forecasting your metrics. And where are those going? Are they moving in the direction that we thought? Or maybe if they're not moving in the direction that we thought, we're okay with that because we're investing, for example. Then of course we know the benchmarks and those are our guide, but I'm more interested in how they're moving relative to our historical data. And is that acceptable?
All right. Dirk, what do you think about this?
Yeah. I also think they are important because they just give you orientation, and they see whether you're good or super bad at something. And of course, it can influence your decision making, how you run the business. So if you see, okay, all of your peers are way more profitably or way more efficient, of course, it may lead to you working on your efficiency rather than something else, for example. So I think it's important that we have them. But again, back to the previous question, we should take them with a grain of salt and not just take them as given and work on achieving top-notch KPIs of certain benchmarks.
All right, thank you. So since we started talking a little bit about metrics in acquisitions, there is another question, Dirk. I think you're going to love this one. Do you aim for the rule of 40 for SaaS companies, or is this outdated as an approach? Dirk?
I like the rule of 40 personally, and I can also mention that it's one of our North Star metrics within SaaS Group. So we look at the rule of 40 metrics of all of our portfolio companies, and we do our best to keep them above. Should you focus on the rule of 40 pre-PMF? I don't know, questionable, or maybe in a product sense in the early stages, maybe not that relevant, but as you grow, I think it's one of many efficiency metrics you should maybe look at. There are other ones, ARR per FTE. So again, each individual KPI doesn't make much sense in itself, but you should at least look at them in a broader picture. And especially small companies that are not growing like crazy, I think for them, the rule of 40 is a good orientation of what buyers are demanding and what buyers appreciate. So yeah, we are talking to many companies that are, for example, VC funded, didn't raise any follow-on rounds because they didn't achieve hyper growth, but then they fall short of the rule of 40, and that's not something buyers in this segment necessarily appreciate. And so they need to work on growing faster or maybe becoming more profitable. So I'm a big fan of the rule of 40. There was the rule of X recently introduced, I think, by Bessemer, but this may mainly apply to publicly traded companies. So I think not that relevant for the companies or the founders that may attend this session here.
All right. Ben, do you think Rule of 40 is still relevant?
Yeah, I think, financial discipline never goes out of style. Before, it's all about growth, then we had the crash, then it's about profitability. Now maybe we're pushing back to growth, but it is a good metric. And it's interesting seeing these big investment firms where they say, hey, Rule of 40 doesn't apply unless you're 25 million ARR and above. I think it's really above 10 million ARR, and I'm even seeing it push below 10 million ARR and getting more requests for the Rule of 40 calculation. I did actually have a request for a Rule of X calculation. But I think for me, when you're less than 10, it's a red flag if it's highly negative, because it's easy to do Rule of 40 when it's early and you have that super high growth, and maybe you have EBITDA burn, but it's easy. But it's supposed to be hard. Rule of 40 is supposed to be hard, when you're above 10 million. So I think it's valid, and I think it's right, the trade-off between profit and growth. And that's very important for founders to understand, because as you're investing in departments and you're building out your department structure, they're going to be competing demands for that capital. Where are we investing? What is that doing for our company? Is it pushing efficiency? Is it pushing growth? So I think it's just good financial discipline to consider those trade-offs.
Okay, thanks for your answers. All right, then we'll move on to our next question. And Ben, this is about one of your recent posts, blog posts, where you were talking about the 4 key SaaS finance data sources, as in booking data, financial people, as in HR and payroll, and revenue data. Why are these 4 the most important, and how to use them in order to build scalable and repeatable processes in SaaS?
Yeah, definitely. So I've created SaaS metrics for a lot of SaaS companies at this point in time. And those are the 4 data sources that we need to create that holistic SaaS metrics data set. Because SaaS metrics, not just revenue related, we need wage data, we need customer revenue data. So those are the 4 key SaaS finance data sources if we're looking to calculate all the metrics that are relevant to our business. Because unfortunately, we can't just say take revenue data and we've got every single metric, right? We have to pair that with expense data, for example, CAC and CAC payback. So those are the data sets that we need on a monthly basis, repeatable basis, that then we push into, for example, for me, my forecast model, which then calculates all my historical metrics and my forecasted metrics. So without those 4 pieces, for example, if you have a CRM system, closed won opportunities, you can't calculate sales and marketing efficiency metrics without good bookings data. That's one of the biggest SaaS data mistakes that I see. So they're just the 4 foundational pillars that we need to have that complete transparency. And if you don't have it now, you just kind of keep working on it. Put these data sources in place, because just unfortunately the metrics are complex and we need different sources to put the complete picture together.
All right, Dirk, could you comment on that?
Yeah, I just want to say, if there are any bootstrappers attending now, they might be a bit overwhelmed, because from my experience, many SaaS founders I personally talk to don't have a proper dashboard in place where they just see every metrics and everything is synced regularly, and they have HR, payroll, revenue data all in place to calculate these metrics. So I'm very often surprised how far many companies got just based on gut feeling and maybe the main KPIs. So I would say, depending on the level where you are, it's at least good if you can provide these numbers to a potential investor or acquirer if you don't have them yourself. And also mentioning the MRR schedule that Ben talked about previously, you should at least have these metrics or numbers ready when someone asks for it, even if you don't use it for your day-to-day operations or to steer your company. Because very often I talk to founders and they send me some weird screenshots of internal billing tools they built themselves, or HR data that is somewhat weird with weird bonus structures for different people. So it's just try to clean up that stuff and try to bring as much transparency into that whole numbers game as possible, even if you don't use it.
All right, thank you. Well, I guess there is someone who wants to avoid that situation. So there is a question from a listener. We're just launching and want to know how to, oh, the do's and the don'ts from the get go regarding the structure of finance, cost, etc. Any like very early stage recommendations? Then what to start with?
Yeah, I'd say this is one of my most requested coaching sessions. So if you're early stage, it's about the accounting foundation, which we know not sexy, but it's so important. And if you're in QuickBooks, our zero is getting that chart of accounts where we have clear and distinct revenue streams, right? We're not mixing subscription with usage revenue into one revenue category. And then thinking about our department structure, and the SaaS P&L. So do we have tech support, services, customer success, DevOps, R&D, sales, marketing, and G&A? I kind of work through the SaaS P&L there. So good expense coding, code expenses by department. It may seem like overkill, if you're 20K MRR, but it's going to pay off later. I've seen so many messy P&Ls and data that's just so bad to unwind that if you start there with your accounting foundation, code to the department level, clear and distinct revenue streams, and your people. Get people and your contractors coded to the right departments on your P&L. Don't mix your dev contractors with your sales contractors with your fractional CFO into one account. We need that by department so we can create the SaaS P&L. So that comes up all the time, is just that nice accounting foundation so we can understand where we're investing and we can start then seeing how our financial profile is taking shape.
Okay, Dirk, any other recommendations, or maybe something that you see companies that don't have much, but it would have been nice to have when they're approaching you?
Yeah, I would say I can only confirm to what Ben already said. So I think it definitely makes sense to set it up right away because at the end of the day, it's worth pure money. If you can provide it, less bias on investor side, buyer side, you can impress people, which may lead to higher valuations, higher exit price. Also from my own experience, I mean, if I talk to founders and I say, hey, like, I need your P&L, and they send me something which looks super confusing, and then you ask questions and they are not able to provide more granular data, or it's, yeah, as Ben said, like costs from a certain department are mixed up with other departments. So this always leaves a negative impression, and it may lead to a buyer or investor just walking away because they don't have time to work on that stuff and clean up your mess basically. So I think it's worth taking the time to set it up properly. And it's not that this is based on guesswork. I mean, there's enough material out there to look what's expected from Ben, a lot of stuff, but also from other people and companies. So yeah, you just have to Google it basically.
That's how we should have started and ended this. Just Google it. Yeah, okay. We have the next question, and we kind of mentioned it a little bit when we were talking about the Rule of 40. But when should companies start focusing on profitability versus growth? Ben, what do you think?
Yeah, I've helped a lot of founders at this point, bootstrap, VC funded, high cash burn or, nice positive EBITDA, consistent financial profitability. And, it's a tricky question because I think if you're experiencing high growth, and hitting 100%, 200% growth, right? It's kind of like hard not to seize on the momentum, try to keep that momentum going. Of course, that is very sexy to say an acquirer or VC firm. You see the high growth. But of course, you have to have the cash balance to support that because usually you're in a cash burn situation when you're in such a high growth mode. So that cash runway has to support that, and just take advantage of that momentum if you're seeing that huge growth. But eventually that changes. Growth starts trailing a bit, or maybe the product market fit ICP is changing. Growth starts slowing down a bit, and then we have to look at our retention profile. Are we keeping our customers? Or now are we kind of in this weird situation where we had high growth, it's coming down, but then we're looking at our retention. It's boy, we're not keeping our customers like we used to. Things have changed. And then I do suggest, hey, it's time to maybe pause before we continue to invest and look at our cash runway. Maybe now we need to kind of fix our ICP. Do we have some product market fit, PMF changes, to kind of fix things first before we make that next push for growth. Of course, all depends on cash balances and cash runway, but that's where metrics and context help a lot. We don't just focus on one single metric, but we're looking what's our growth pattern, new and expansion, what's our ARPA, what's that yielding, what's our retention profile, and looking at those together to say, hey, maybe it's time to pause. But I always say you need a path to profitability. Even if you're in that high growth going off after the momentum, you need to be forecasting and what does it take to get to profitability. And it's a big red flag if you're forecasting and you just can't get things to work, like you can't get gross profit to go up and certain mechanical things are not working in your business, then that's a big red flag. So there's so many moving levers, but you have to see kind of what's happening with your metrics, the growth, the retention, to see if we should continue to push, or maybe it's time to fix things before that next push.
All right. Thank you. Dirk, what do you think?
Yeah, I mean, it especially becomes relevant for many VC funded companies, as I said earlier, that are now trying to continue in a more bootstrap manner, sustainably, because they are forced to or because they want to. And so, yeah, many of these companies are suffering because their growth comes down as they transition to like a break-even profitable company. And so also a sentence I hear quite often from founders is, we always reinvested everything into growth. But then the growth should also be visible, and very often it's not. So if you're running a company that is not growing and not profitable, and you tell me you always reinvested in growth, then there's something wrong. Then you should have focused on profitability maybe a bit earlier, because like also to buyers' interest or acquirers' interest in this regard, nobody wants to buy a business that is flat and break even. And so you need to work on either bottom line or top line. And also there are many founders that are saying, yeah, but we expect to grow again next year. It's also like kind of a standard phrase. Well, but then we cannot pay like based on your forecast. So we would acquire the company as is, and you can have like an earnout to prove that this is right. But it's not like the VC game where you can get quite far with great storytelling. So it's like, okay, then prove what you're saying, but we share the risk for this, or you are sharing the risk for this. And so, yeah, also back to the rule of 40, right? So you should try to make sure there's a good balance.
Thank you, Dirk. All right, so we have another question, and I guess we covered a bit of that already, but can you elaborate based on the life cycle stage a startup is in on what should be done in terms of finance and structure? Ben?
I mean, just generally, working with a lot of founders, bootstrap founders, obviously debt is a hot thing in SaaS, all the debt financing, MRR financing, to kind of get you through those working capital deficits, because where it's like, hey, I don't want to give up equity. I don't want to dilute, so debt, a lot of debt players now, a lot easier to get debt, getting debt, in a couple days versus going to your local bank, and taking months. Now, in my SaaS tech survey, I asked about debt financing, and local and regional banks still the most popular player, followed by a lot of those players that we heard of for debt financing. So that comes up a lot in my discussions. But of course, it just depends. And of course, I interview a ton of founders, and sometimes even if you're thinking about just I want to bootstrap, but sometimes the product requires a ton of investment. It's just so complex. You just couldn't bootstrap your way, with a product where it just needs a lot of heavy engineering. So there are a lot of good reasons, even if you're thinking, hey, I want to bootstrap, there are a lot of good reasons to take on equity to grow your business. So it's just like the right, you're kind of right metrics, right stage, the right type of capital for the right stage of your business.
Okay. Dirk, care to share your thoughts?
Yeah, so I mean, I'm advocating for bootstrapping, but as Ben said, sometimes it just makes sense because you don't have the cash at hand to just bootstrap something that is super R&D heavy. So I'm actually a big fan of just raising a small seed round and then just take it from there and see where it leads you. So if you can, find product market fit, how far can you get? Because I think not having that much cash at the beginning also requires you to listen more to customers and talk to customers than listen to investors and other parties. And maybe it also helps you to stay productive at an early stage, to really iterate quickly. And then if you see, okay, there are first signs of product market fit and you're gaining traction, then you can still like say, okay, I go big and raise more capital. And yeah, regarding that whole debt financing, I mean, that also requires you to track all the metrics and to see whether you can pay back that debt within a reasonable period, and what it actually costs you to get that capital on short notice, because very often it can become quite expensive and you better go to your bank and ask for a loan. So you should definitely compare different options, whether it's equity or debt, to see how that influences your cash availability and your long-term trajectory.
Thanks for your answer. So, since we started with the guest questions, there are a couple more specific ones. Which metric do you think a VP of sales should focus on in a company that is in its early stage of growing and sales? MRR, ARR, MRR churn, CAC, or LTV? What would be your recommendation, Ben?
Yeah, VP of sales. Of course, not a sales expert, but of course, CFO is very involved in the sales and marketing function, the go to market. We have to understand the mechanics, how that's working, whether those goals, that the VP of sales is shooting for. Of course, pipeline creation is big, pipeline velocity, lead flow, conversion rates as you move through your pipeline, and how many how many opportunities are being created. So looking at that, the pipeline, the health of the pipeline, because as a CFO, I'm taking that weighted pipeline and then forecasting the revenue. So we have to have good visibility around that. And often with SaaS companies I work with who are less than 10 million, usually there's not a ton of visibility there. Usually I'm doing the revenue forecast based on trends because they just don't have their CRM set up correctly, or they're not tracking the right data, or not using the CRM at all. Then we don't have visibility. So we have to track those opportunities and the stages in the pipeline. Again, not a sales expert, but just some of the things that I'm looking at, to make sure we can produce some nice revenue forecasts.
Okay, Dirk?
Yeah, I mean, I'm also not a sales expert, but maybe adding to what Ben said, depending on what early stage you are, you may not even need a VP of sales yet. So, I mean, if you just got started a couple of months ago, and you don't even have any revenue yet, I think you should wait to hire a VP of sales, because this is more about implementing processes than being on the front line, reaching out to customers and trying to acquire customers. But yeah, nothing to add to Ben's words about like pipeline velocity and customer acquisition and conversion.
Okay. Another one is, do you have any recommendation on what financial systems or software to use that is suitable for a 20K MRR business to set up the expense coding?
Oh man, so I've got the perfect report for you. So I've released earlier this year my 5th annual tech stack report, just focused on SaaS companies. And it's not a market map, it's what's being used. And I also asked all the participants to put in their ARR size so you can see how the tech stack changes over time, which it's going to if you're 1 million versus 50 million ARR. So maybe somehow if you go to my blog, saas.cfo.com, you can download it there. But right, usually everyone starts on QuickBooks or Xero, and then for expense reporting, it used to be the old school days of T&E, like Concur, Expensify. Now we have this whole new category of spend management in corporate cards, which is wrapping up all the expense management, kind of budget management with those cards. So now you see solutions like Brex and Ramp and those others, who are P cards plus expense management, that you can look at. So at some point, that's an easy win, is expense reporting. If you have corporate cards, credit cards, that you're not just manually coding all those expenses, which I see all the time. So if you do have travelers, if you have heavy use of that, an expense reporting system is an easy win on the finance and accounting side. But that tech stack report is 50 pages and goes through all these different solutions for finance and accounting.
Delightful. Dirk, what are your favorite tools?
Yeah, I mean, I always appreciate if founders are coming to us and say they are their SaaS business is based on Stripe, QuickBooks, and they're using maybe Chartmogul or Profitable or whatever for KPI tracking, because this makes it much easier for us to just request CSV reports and then take it from there and do our own calculations. So yeah, maybe don't make the mistake and try to build it yourself as like some fancy proprietary tool, and just take what's out there. And yeah, as Ben said, just read your report and you will find more about what others are using.
Okay, perfect. All right, so we're slowly coming to an end, but we have a few really interesting questions left. So could you give an example of certain metrics that are being overlooked and how it could affect the business in the short and long run? Ben?
Yeah, one I always talk about in my metrics course is ARPA or ARPU, so average revenue per account. Because if you think about it, we want that to yield higher and higher over time. So is that chart moving up and to the right? Are we getting more revenue per customer as we move forward? So I think an underestimated metric, and I use this a ton in my forecasting process. If we think about our MRR waterfall, so we have beginning MRR, new expansion, contraction, churn. We have ARPA per each of those layer. Are we churning out higher or lower value customers than what we're acquiring? What are we acquiring on a new basis? How much are they expanding? So ARPA, I find, very simple metric. Of course, say just total subscription revenue divided by total customers, but then we can segment it by product line, by geo, etc., by ICP. So a simple metric, but I find not used enough. And I use this every time I create a forecast for SaaS companies. And also just chart your ARPA, chart it by product line. We want, of course, that yielding more over time.
Okay. Dirk, what do you see from companies approaching you?
Yeah, not necessarily an individual metric that is overlooked, but maybe miscalculated or not looked at all. So one I would say is doing a proper segmentation and cohort analysis. So this is being rarely done. I mean, Ben also said it like by product line, by maybe acquisition channel to just see like, okay, which customers are maybe stickier and where's the ARPU a bit higher, also to refine your acquisition strategy maybe in the first place. And so, yeah, this is something I would encourage people or SaaS founders to do, like really looking at cohorts from a sign-up date basis, but also geographies, etc. And then maybe also something that is miscalculated quite often is LTV to CAC. So, I mean, I also joked about it in one of my posts recently, because many founders come to us saying my LTV to CAC is like 50, 55, 47. But then it's just like they don't consider the right metrics, or it's just like super simplistic formulas. So I think it also makes sense to, if you want to brag about it, then also calculate it correctly.
That makes sense. Okay, so can you explain the importance of deferred revenue in SaaS accounting, Ben?
Yeah, so deferred revenue, really important for SaaS companies. So if you invoice in periods longer than a month, so like a monthly invoice, you say you invoice quarterly invoices, semi-annual, annual invoice durations, right? We've got to defer that revenue because we haven't earned it. So we invoice that revenue, we basically park it to the balance sheet. So think about a 12,000 K annual invoice. We don't post that to the P&L, that's cash basis. So we've got to post that to the balance sheet, and then we pull over the right amount. We spread that over that contract duration or that subscription duration. So maybe if we're doing it on an even monthly basis, we pull over 1,000. Daily rev rec is also very popular, but that's the concept of deferred revenue. If you're invoicing monthly, usually you're good. Depends on your auditors, but anything over that, then we have to think about deferred revenue. And usually I tell SaaS founders, say in the 3 to 5 million ARR range, it's time to think about revenue management, rev rec, because with that cash basis P&L, it's hard to understand the economics of your business. If in one month you have 300K of revenue, the next month you have 50K, well, what's my gross profit? What is my true MRR? What actually is my MRR? So that's where deferred revenue comes into place. And usually your bookkeeper, your accountant, whoever can take care of that. But at some point we have to consider that.
All right, Dirk.
Yeah, I mean, I agree to what Ben said, of course, and I see it very often that like founders get started and they maybe know an accountant because it's a friend of them or whatever, but they don't know anything about SaaS, and so that's also when founders come to us and show us accounting on a cash basis, and it just gives like a wrong picture of the whole business and the profitability of the business, etc. And then we first have to explain to them like what's happening there. And also like they got cash for like longer contracts, but then sell the business to us, but we have the costs that occur only for us and stuff like that. So it just gives a wrong picture of how profitable business is and how the cost structure of the business is. And so I can really encourage founders to look at it and also start doing it right away. Yeah, because it's just super important. And like many founders are just surprised when we tell them like, I don't know, you're running out of cash in 2 months if you don't do anything and stuff like that, because they are just not getting the full picture because of false accounting principles.
All right. I think we got an interesting question to follow up. Are there any standard ratios of revenue for functions like sales and marketing, R&D, and others? Ben, what do you think?
Yeah, they're definitely ratios and a lot of great benchmarks. I use these benchmarks all the time. So one, think about our OpEx profile. So R&D, sales, marketing, and G&A. So R&D as a percent of revenue, definitely we're looking at that. How is that scaling over time? And there are benchmarks based on your financial profile, your ARR size. G&A, I sit as a CFO, I sit in G&A. Is G&A 30% of revenue or is it 15% of revenue? And that also helps you understand your profit path to profitability. And it's going to change over time. Early on, R&D as a percent of revenue, really, really high. Then it scales down over time. Now, sales and marketing as a percent of revenue is interesting. That just tells us if we're investing or not investing in sales and marketing, but it doesn't tell us anything about efficiency. So good to track, but then that's where we're looking at efficiency metrics to determine, that percentage. So definitely on the OpEx side, you are definitely looking at that's changing over time. And then COGS, really, we're looking at that gross profit. How is that changing over time?
Okay. Dirk?
Yeah, I mean, I can recommend maybe reading one of my recent saas.wtf newsletter articles where I digged a bit deeper and I took two analyses from Kyle from OpenView and Tom Tungo from previously Redpoint. So they analyzed it, but more of like a team size and less of a cost structure basis. But you can see that R&D is super high in the beginning because, of course, you need to develop the initial product. And then it goes down, and marketing and in general go-to-market costs are increasing. And you can also see that as you grow and as it becomes an organization rather than a product with a team behind it, you can see that sales, even for PLG companies, becomes way more important in the medium to long term. So you can see that marketing is growing, of course, but not as much as your sales function. And so it at least gives you an indication of like where the costs or how the costs are distributed.
All right. Okay, and I guess it makes sense to finish this session with something related to what we do at SaaS Group. So, what are the most important KPIs influencing valuation in an exit? Dirk, want to take this one first?
Yeah, I mean, we think we covered all of them already. So for us, it's definitely important that you can acquire customers profitably. So that's what we touch upon. And then retention is super important for us. I mean, we have a stronger focus on PLG products. They tend to be lower in terms of gross and net dollar retention because these are just like low ARPU businesses, and the solutions tend to be less mission critical. But still, you should show that you have like good retention metrics and that you are deeply integrated into customers' workflows. And then growth is important for us. I think in general, it's still the biggest valuation driver in the whole SaaS space. But for us, the balance between growth and profitability is equally important. So also back to the rule of 40. Then also gross profit margins. I mean, if it looks more like I don't know, a tech-enabled service or stuff like that, because you have like 60, 50% gross margin, that's not for us, and that's not really a SaaS business. And you shouldn't also expect to get a valuation that is based on your revenue, but less on your gross profits, maybe. So yeah, I would say these are super important. So growth, but growth versus profitability. So a good balance there. Efficient, profitable customer acquisition, sticky product, and good quality of revenue in general.
All right, Ben, what have you seen in your experience other acquirers looking at?
Yeah, I think it depends on the stage. If you're a million or 10 million or 20, but thinking if you're a little larger, you'll have some nice size. That's where I use my metrics dashboard. Looking at growth, looking at retention, margins, our rule of 40, and then of course efficiency. So I think valuation a bit art and science, but the more we can do on the science side, understand how we're performing, how does that benchmark against our peers, and again, the big thing, the health of your recurring revenue, your MRR schedule, retention schedule, that's a huge component. But it's all those metrics and financial concepts kind of combined, that tell us that whole story, and how is this company really performing? That's going to influence that valuation.
Okay, thanks. All right, then I think we have just one more question, and it's a bit more personal to you guys. So, what are the biggest challenges you face in your daily work, Ben?
Daily work, personally, time management, calendar management, but for me on the CFO side, data, right? Good data, repeatable data, because that really drives the metrics calculations, drives our forecast. So we have to understand the data structure within our business, the systems in place. CFOs are stewards of the data within the business, and we have to influence that. So it's so cliched now, but truly we don't take advantage of all that data that's trapped in a SaaS business.
I try to keep it as related as possible to this session. I mean, we have a lot of ongoing conversation streams with founders to talk about M&A. We have big ambitions for this year. We want to do many acquisitions, and so this is quite challenging. Also, in terms of time management, as Ben said, but also to refer to this session today. That's what I mean with you create a bias if you don't deliver metrics, but you also risk that buyers just walk away and focus on the next opportunity, because we need to be fast and because we want to do deals. And if you're not delivering on time, and if you're not delivering the metrics that are required to put a price tag on your company and see if we can agree on something, then you may just lose out. And so it's super important to be prepared and to have these numbers ready if someone is asking for it, because it can, at the end of the day, make or break an acquisition or an investment.
Well, thank you so much, guys. I mean, it's been incredibly valuable. I think, we have the highest retention ever for this session. So just as forecasted. But thanks so much for everything you've shared. And I think more people would love to ask their questions, and hopefully we can do it again sometime.
Sounds great.
Yeah, thank you.
Thanks, everyone.
Yeah, and take care.